Hi, it's Robert Weinberg, and on this channel, we empower individuals to create freedom through expert financial and mortgage strategies. If you're new to the channel, please go ahead and hit the subscribe button and also hit the bell so you get notified on all of our future content. In today's lesson, I want to talk about homeowners insurance strategies. So when you're getting a mortgage, either purchasing or refinancing your property, one of the conditions of getting that mortgage is that you show the lender that you have adequate homeowners insurance that would pay the mortgage off in the event of a catastrophe or something that caused an insurance payout. There's some specific tricks and strategies that I want to share with you that I've been using with my clients for a long time that can help you to get the best and most adequate insurance policy for your particular needs. So the first thing is you want to be picky about who you do business with when it comes to insurance. You need to choose wisely, and the best way to find an expert advisor when it comes to your home insurance is to get a referral from either your mortgage advisor and or your real estate agent. They'll have a good idea of the best insurance agents and companies in your area, and that'll give you a good place to start. Now, I usually recommend to my clients when you're shopping for your initial policy, you talk to anywhere from 2 to 3 different insurance agents or insurance companies. That'll give you a good idea of the different offerings out there in the marketplace and what some different premium amounts that you may encounter so you can get the best deal. You want to look at multiple deductible and coverage options. A lot of the time I see first-time buyers make a mistake where they just go with the first quote that they get, and that quote might be a $500 deductible, it might be a $1,000 deductible, but it may not fit in with your overall financial profile. So the lower the deductible is, typically the higher the premium is going to be on that policy. So if you're someone that has a few $1,000s in your emergency fund, which we recommend for everyone, if you've watched some of my other videos, you know that that is a very important thing, to have an emergency fund. So if you've got that intact, then taking a policy with a $500 deductible or a $1,000 deductible may not be the most cost-effective way to get insurance. You may be paying more than you really need to. Coverage options. So some companies will give you a policy based on the replacement cost of the property, and I've seen this vary. Sometimes the replacement cost can be a lot more than you're paying for the property or that you think it's worth. Sometimes it can be less. So that's one of the reasons that talking to multiple insurance providers and multiple insurance agents can really be a big benefit, so you can talk about different deductible and different coverage options. Now, when you take an insurance policy for your home, it's very likely that the insurance company will also offer auto insurance as well. So it's usually a good place to start is to talk with the company that's already insuring your auto and ask them if they also have home policies available, because what they'll be able to do is give you a multi-policy discount. So the way that works is if you have more than one policy with that company, then you'll get a discount on a new policy you bring on. So if you have auto and you bring on a home policy, you'll typically get a discount for having those multiple policies. That can be great, although it's not required. It can be a way that you can save a significant percentage on the premium amount for your new home policy by bundling it with your auto. A huge strategy that I use with my first-time buyer clients or move-up buyer clients is, typically when you're purchasing a home, you're tight on money to close. Not always, but a lot of the time. So one of the ways we can mitigate this is that the lender is going to require that the first year of homeowners insurance is paid at the closing. Regardless of whether you're escrowing to have that included in your mortgage, they're going to want to know that that first year is paid at the time of the closing so that you're insured for that first year in the property. So typically what's done is they'll add that to the closing statement. They'll add that to your closing funds. It'll be just lumped in with your other closing costs, and they'll put in that insurance premium. Well, typically that insurance premium can be anywhere from $900 to $2,000 a year, sometimes even more depending on the type of property. So that can add anywhere from $900 to $2,000 to the amount that you need to close. So one of the ways that you can mitigate that is by actually paying the first year premium on a credit card before closing. You'll want to coordinate with your mortgage advisor on this, but usually it's going to be about a week ahead of the closing when all the numbers are getting tabulated. you'll want to go ahead and contact your insurance provider that you've secured a policy through, and you'll want to make a payment to them. You can do it over the phone. And the reason why you want to use a credit card is that you're going to be bringing money to closing from your checking or savings or 401k or wherever the money's coming from. So you're going to be limited in the amount of money that you can bring. So by paying it on a credit card and not a debit card or not a check ahead of the closing, what you're essentially doing is giving yourself a grace period to where you can pay that premium back after the closing. So maybe 2-3 weeks later after closing, you get paid at your job or you get another influx of money. You can then pay that credit card off, or maybe you need to float it for a month or two and pay a little bit of interest. But either way, it helped you get in the home with a lesser amount of cash because you have time to pay that over a period of time instead of needing to write a check or pay that in quote unquote cash to close at the time that you bring your down payment and all your other closing money. So that tip right there can save you anywhere from $900 to $2,000 or more at your closing. Now, the last tip that I want to give you about homeowners insurance is to do an annual review. Just like we talk about doing a mortgage review at least once a year, you also want to do an annual insurance review, specifically on your home and auto insurance. So the way you want to time this out is based on within 30 days of your renewal. So if you buy a house in June, then the following June, that policy is going to renew. It's typically going to be a 1-year a 1-year policy timeline. So about 30 days before your policy renews, you'll probably get something in the mail from your insurance company letting you know what your new premium is and any changes to your policy. You want to use that as a token to say, okay, now's the time that I need to go and look at my insurance policies. And you want to then talk to your current insurance provider and talk to 1 or 2 other insurance providers as well that you can get through referrals from mortgage advisors or realtors, and you want to talk to them about your policy and make sure that the policy that's in place every year is the right one for your needs. You want to make sure if you have more money in savings now, maybe you want to go ahead and raise that deductible up and get a lower premium. If you've done an addition or some work on your home, in that case, you might want to change the coverage amounts. You might want to increase the coverages on your policy to make sure that you're adequately insured. But what I find is a lot of people just don't look at their insurance for several years, and it's only when an advisor like myself looks at it and says, wow, you're overpaying on insurance, that they use that as the spur to go and say, okay, now's time to reevaluate my insurance. So don't wait for that. Really proactively on an annual basis, look at your insurance. Best case scenario, you just stick with what you've got and know that you have a great policy. But worst case scenario, you might be able to actually save money by going somewhere else and switching over your auto and or home. So I hope that you'll share this with others that may benefit. I hope that this helped you in your pursuit of getting a mortgage. And I hope that you learned something here. Please leave your comments below and feel free to follow me on social media. If you need expert financial and mortgage advice, reach out to my office via call or text. We'll talk to you soon.